Hello, everyone, and welcome to this session of Portfolio Analytics using Artificial Intelligence and Machine Learning. My name is Ramin Okhrati, and together with my colleagues Paul and Sohail, we will be running this session for you. So we will have a very brief introduction. We introduce ourselves, and then we will move on to 30 minutes of questions, and hopefully there will be enough time at the end to address some of your questions. I assume you all have this Barella app, so please ask your questions through that app. I will then receive them here, and hopefully there will be enough time to address them. All right, so I'll start the introduction with myself. I am the head of Artificial Intelligence Risk Laboratory, known as AIRiskLab at University College London. Together with my team, we are heavily involved in developing AI technologies specifically for financial risk modeling. I am also the program director of MSc in banking and digital finance. So we position ourselves at the intersection of finance, computer science, and statistics. All right, Sohail, please introduce yourself.
Yeah, afternoon, everyone. My name is Sohail Raja. I work at Societe Generale. I head up the platform business for our global markets franchise, so pricing and execution for our multi-asset range, which includes structured products. I've got a good relationship in terms of providing those products to wealth. That's why I'm here today from a wealth perspective, but I'm much more on the investment banking side, productization, and a parallel role is to look at digital transformation, data, and machine learning, as well as other new aspects around DeFi and blockchain and crypto assets as well. I'm spending a lot of time on data, as you can imagine, based on the conversation today, and a lot of AI and machine learning projects that we're running to support our clients as well as internally.
Thank you so much, Paul.
Yeah, good afternoon, everybody. Paul came from KPMG. Management consultant, as you can probably guess by background, but also I spent 5 years at Schroders, where I was head of digital enablement and head of their global artificial intelligence and analytics practice as well. So both experience of being both industry side and a consultant. These days I'm at KPMG's wealth and asset management practice and very much interested in technology-driven change and transformation, and all the technologies that Sohail mentioned are of great interest to me as well.
All right, thank you so much. So I'll start with the first question, and it will be for Paul. So Paul, we know that developing AI technology is such an expensive procedure. It's time-consuming, it requires people, resources, so it's not very easy to do that. So that means that, you know, as firms or any institutions, especially financial institutions, we have to be careful of developing what kind of technology and for what purpose. In other words, we're talking about the auditing of this financial technology. So the question is specifically how we can conduct our internal audits to determine for which area and how to develop AI technologies.
Yeah, great, thank you. Really interesting question to get us started on, I think, because our industry, maybe like lots of industries, but I think particularly in our industry, you will hear the phrase a lot that technology X is a solution looking for a problem. And that's not completely unfair sometimes, but I think particularly when we actually think about things like AI, machine learning, that doesn't have to be the case. So I'm not a heavy practitioner, so I always start with like what's the business case, what's the value here, what's the opportunity or the problem we're trying to solve. So start with what are you actually trying to do first of all, and is that a suitable problem? So the next layer down therefore becomes you're going to get sick of hearing me talk about data, because actually this is about data. So these solutions are completely driven by the data and the data that you have available, the quality and the extent of those data sets. So look at your data, that what you've currently got or what you could get hold of, and work out, is that going to be suitable for an AI machine learning solution? If not, again, that's sort of the next stage gate, that's off the table. I think the next one again is a bit of a practical one. So assuming you've got the right data, you can build the models, etc. Are the outputs going to be believed by whoever your key stakeholders are? And that might be your executive management, it might be your end client, it might be the regulator. You might have great data and great models, but if nobody believes what's coming out, again, it's been a bit of a big waste of time and money. So are the outputs going to be believed? And then essentially a couple of other things I'd think about as well. So why are you going after AI ML rather than humans? There are some things that they'll do much better than humans. There are some things humans do much better. So if it's for efficiency or speed or reducing complexity, then great opportunities there. But let's not think that it's the answer to essentially all problems. And then finally, the ROI. How much investment how much spend are you going to have to basically spend to get this up and running, and what's the return on that going to be? So just a couple of criteria there that I would be looking at to essentially evaluate any opportunities.
Okay, great. So basically, just because it's AI, it doesn't warrant to be used for a specific problem. So it depends on the data and its structure. Sohail, would you like to add?
No, I'm glad my colleague from KPMG answered the audit question rather than myself. But I think I concur with everything Paul said. From a practical, pragmatic perspective, we look at things from a use case driven approach. Data, as you know, within banks is more than plentiful. I think we've heard all the analogies around data and oil and rest of it. I'm not sure you can say that in an ESG space now, but we have all of that. The challenge is, do we have the right data, the right quality of data? Do we know what problem we're actually trying to solve and what benefit we're going to get from that? And that leads to, I think we'll cover this in some of the other questions anyway, so I won't answer them now. But I think from an efficiency play and automation, that seems to be the initial driver in terms of what we're trying to do. And then the third aspect is around revenues and client relationships, and how we either generate new relationships or embed those relationships further within the conversations that we're having with clients.
All right, thank you so much. So we will move on to the next question. I don't know if you agree or not, but when we apply the AI systems, the same system that's developed, let's say, for engineering purposes, when we apply that for financial problems, normally we will see a drop in performance, and that's very well accepted. So the next question, which is actually for Sohail, is now that we know that phenomena that happens actually, what technologies have proved to be the most impactful in financial modeling in general, or in which area of finance?
Yeah, I'll take a little step back on this to start with, but I think what we've done is change the way we look at data itself. Everyone here uses Excel, so we've tried to move away from Excel, VBA to Python, and using Jupyter Notebook from a tooling perspective at least, and that's changed a lot of things in terms of how we actually do things, how we actually analyze the data, how we can visualize that data and get some decision making out of that even before we get to a model, and then getting access to that data, whether that be through data lakes, data servers, serverless data environments, etc. So you've seen that technology maturity from a pure infrastructure play change a lot. And I think in terms of the actual tools that we're using, so unsurprisingly within banking, there's a lot of process, a lot of documentation, a lot of term sheets, and I'm sure people are fully aware of that, confirmations, etc. They're still very much email driven, unfortunately. There isn't any smart workflow automation. Is getting better with some of the providers that are doing that, and some of the banks are doing that themselves, but we're heavily dependent on documents. So NLP is our key one. It doesn't sound very exciting, but NLP is one of the key tools and technologies that we use from a machine learning perspective, mainly to, many things. One is legal documentation, term sheets themselves, invoicing, chargebacks, fees, getting all that information, not via emails, but getting it through into a data set that we can then extract those items, those key information, get that to our salespeople, to our operations teams, as well as our back office teams. That's been a definite program of work that we've done quite heavily. And that moves a little bit towards deep learning in terms of some of the documentation we get is obviously image-based, and we're trying to extract data from the images themselves and be able to categorize that and prioritize those data sets. And then the other side of it is around predictive analytics, particularly around our pricing capability, trading, and what the best trade opportunities may be in portfolio set up for our clients, as well as our trading desks, to be able to use some of those technologies as well.
Right, thank you so much. Paul, you want to add something?
Yeah, just quickly. I think I would, for me, the question is where is their current use? But I think the really exciting bit is what's the future look like? And for me, there's all the efficiency stuff, which is brilliant, that Sohail's been talking about. But also the future is that personalization for the clients and really enhancing that client experience. And that's where one of the areas that I've seen today that impacts on that personalization is actually going in the opposite direction from the NLP stuff. So it's actual natural language generation, going from structured tabular data and changing that into commentary narrative that sounds like it's been written by an actual human. Again, may not sound like the most groundbreaking thing initially, but when you think about personalization, having a client that logs into a portal and then is able to select, a non-standard time frame. So I'm interested in the last 4 months of the performance of my investments, as an example. I select 4 months, and then essentially, rather than just showing me the performance and the attribution numbers, I get some commentary dynamically produced and immediately sent back that speaks in language that I, as a normal individual lay client, actually understands. I think that's a very obvious sort of application of where AI machine learning can be used for personalization and enhancing the client experience. So I think that's quite interesting as well.
All right, so involving lots of unstructured type data. All right, so we will move on to the next question. So in general, when we deploy AI or machine learning, there are two philosophies. One of them is that let's build everything ourselves, so build the infrastructure, the team, and basically solve the problem within our firm or company. This is one philosophy. The other one is about renting or importing the same technology from outside, let's say the bigger companies or those that are specialized in artificial intelligence. The next question is that how we can actually make a balance between the two and which option we have to opt for. Paul, I would like to start with you.
Yeah, for me, this is classic, a buy versus build question. I guess, first of all, I don't think it's a simple dichotomy of you buy everything or you build something. I think, again, you look at the business value, the use case, what you're trying to do, and it might be a blend of that. But for me, there are probably 3 factors that go into that sort of those buy versus build decisions, and typically they are competing factors. So it's, you prioritize one, and that means you deprioritize the other. So the first of all is how much of this is going to be stuff that makes you unique and gives your company your competitive advantage versus something that is or should be commoditized, and balancing that against speed to market as well. So typically, obviously, if you want to go out to market quickly with something, then usually the buying something is obviously a lot quicker. But if you want something that isn't commoditized and you want very much to be your own IP, then slower route, but typically build it yourself. And then we're going to come on to talk about this later, so I won't labor this point too much. But the other one, of course, is the availability of the skills and knowledge within your organization to do these things, which is absolutely key. So I won't label that point now, because I think we're going to come back to it. But for me, those are the 3 sort of criteria that you're trying to balance when you're making that buy versus build decision.
Yeah, I mean, just to add to that from a SocGen perspective, or even from my perspective, I've got a engineering mindset. So mathematics is my background, and most of the engineers that we've got in the teams have got a maths background, so they're very happy to use tools. And we're a big open source platform user, if you like. We take the open source platforms that are out there, so things like scikit-learn is freely available. A lot of the graduates that come through to my team have picked up that knowledge anyway and know the models that are out there. So in terms of getting something up and running, once you get past that whole challenge of data and understanding data and data quality and getting people to take responsibility for that data, which isn't as easy as some people think it is actually getting engaged and making sure the data itself is of a quality that can be used and that they own it and change it themselves if they have to, in terms of ensuring that even before that even gets to a data modeler, that work is done. We're happy to work with the teams to enhance that, but we won't get to a model until we've actually cleaned that data up and worked out the use case. And we use a lot of open source models to get the initial business case together or ROI together before we look at third parties. And those third parties or fintech providers, the market's changed in terms of classic fintech relationships, I think, from my perspective, particularly as we've moved a lot towards cloud and making our own data and our data analytics available within, for example, I don't want to name Amazon, but I'm going to name Amazon. Amazon Marketplace, for example, that's where a lot of providers are going now, buy side and sell side, to offer either machine learning algorithms or data sets that can be enhanced. It could be structured or unstructured data, but really building up that whole data story is probably really key for us. And when it's the right time to use a third-party machine learning algorithm, it will be for a specific use case. Once we've done all that due diligence in terms of has it reached 80% of what we want, is the extra 10-20% worth it in terms of the cost, in terms of what we'll get back from a revenue or a cost-saving perspective. So we're much more towards subscribing to a model rather than buying in a full company. We've done some strategic investments in some machine learning companies, but that's been very specific to, let's say, research, for example, or quants, where it makes a lot more sense to partner up with a number of firms that are doing models in that particular space.
All right, thank you so much. The next question is more about practicality of employing talents for the firms and financial institutions. So it's really well known that talent acquisition is a really big challenge for many companies to find people and hire people that they have the right skills for the task that you are intending. Not only that, there is also a retention, that how we can retain these talents within our firm or financial institutions. So the next question is that to what extent this is a bottleneck? And Paul, I would like to start with you.
Yeah, thanks. I think this is a massive topic, a really interesting one, and probably I'd like to get started with just maybe a couple of cautionary notes. So I've seen, I think people have learned lessons maybe over the last couple of years, but I've seen some really big managers that said, we want to go and do something big in this area. We want to make a name for ourselves. We want to go and hire a massive team of very expensive data scientists. Excellent. But then they get them in the door and they realize they can't really do anything because they haven't got the right ratio of the data scientists to the data engineers. So they can't ingest the data into the organization. They can't move the data around the organization. And you now have a big team of expensive data scientists sat there very, very frustrated. So don't just think about, this isn't just data scientists, it's data engineering, it's this other technology folk. So yeah, you've got to think about that, the whole wider complement of skills that you need to do that. A couple of other things, slightly sort of side note, but one of the other speakers today talked about the ebb and flow of senior executive support for technology projects. And I think if we're talking about skill sets and knowledge that is lacking in organizations, and I think sometimes that most senior, that sort of board level, exec level sponsorship of these types of programs can be hugely variable. So I think that's a bit of a skill gap as well, particularly if markets are going to fall and budgets are going to fall or be cut. I'd be slightly worried about that skill set as well. And then, as you're saying, a lot of this is about how do we attract people, because the reality is, you know, Sohail mentioned Amazon, but you know, if you want to be doing these things to some degree, you are going to be in competition with vendors in this industry, but you're also going to be in competition with big technology companies, and therefore it's everything. It's salary, it's company culture, but because this is again all about data, this is about how big are your data sets, what exciting, interesting stuff can you do with your data to really attract these people. So there's definitely a war for talent, and I think it is quite a bottleneck.
And I think it's getting even more challenging as we move on. All right, Sohail, I think you're about to talk on retention issue.
Yeah, just before I talk about that, I think on the attraction, retention, or getting people into the firm, clearly banks used to be a place when I was looking for a job that everyone wanted to work, and we were technologically ahead of a lot of companies. That clearly is not the case, right? But at SocGen, we certainly built a stack which is very similar to what you would find at a FinTech. But I think the attraction side, what we try to do is particularly with new talent and at a graduate level or even apprentice level is not worry about their background, not worry about their CV. It's actually getting them in front of a data set that we would provide. And we've made that available on GitHub, and we've got AI Kit, which is our own machine learning algorithm that anyone can access, and you can contribute to that, going back to the open source methodology or approach. And what we're looking for people is to take that data, create their own Python scripts, create their own Jupyter notebooks so they can share with us. So we can actually look at that directly without having to worry about whether they went to Imperial or whether they went to UCL. No offense to UCL, but that has its place, particularly with our quants guys. I'm sure they'll be a lot more interested. But that day-to-day data and understanding data analytics and working on those use cases are key. And having the skills right from an attraction perspective is very important. The other flip side is that we seem to forget sometimes within firms, and it goes back to your point about senior management pool and culture. And I think culture is key as well, and retention is key in terms of we have people in the organization who have this knowledge. They know the data, they know it inside out, they know the gaps within a operational workflow, which doesn't sound exciting, but if there's a break in a trade or there's a break in a price request, the first person that's going to be calling is a client. Is going to call, client's going to call sales. Sales is going to be on the case of operations, which is a pretty unfair relationship sometimes, right? So they all have the knowledge, they all have the data, they have all the experience around understanding that need. And what we've done is gone through quite a large retraining exercise, again, getting people involved in the data engineering aspects, the data analysis aspects, being comfortable using Python and Jupyter Notebook as being their day-to-day tooling. And that's how we've tried to ingrain that before we even get to a data scientist approach, and we didn't go through the big bang of trying to hire 100 data scientists and then figure out what we're going to do with them. It was very much an evolution perspective, and working with them, now being positive about working with the UCLs, but working with the UCLs of the world to get the right level of data scientists who understand our business and understand the context of the challenges that we have in those data science roles.
All right, thank you so much. The next question is about one of the really main challenges of artificial intelligence or machine learning, and that's explainability. So the traditional model, let's say the statistical model, traditional model, to some extent they are self-explained. When you build the model, actually you can gather a lot of information around explainability of the model. The same cannot be said about artificial intelligence model. And that's one of the big challenges in artificial intelligence and machine learning in general. And this becomes even more difficult when you actually buy a model. This is also related to the regulation. So you have not developed the model yourself. It's developed by a third party. How you can be sure that is compatible with the regulation? How you can interpret and explain that model? So we cannot have this scenario that you have used a model for a few years and then a regulator questioned the model on certain aspects. And I'm sure that just saying that, sorry, I didn't know, is not acceptable. So this question is for both of you, but I think I will start with Sohail.
Yeah, it's an interesting one. I think there's a challenge to even explain what explainability is, right? And the rationale and the reasoning behind that, and why we need that. And I'll give an example that we've just done recently with ESG. We had, as you can imagine, most banks and everyone now talks about ESG to quite a high level. We get a lot of data. We already talked about structured and unstructured data sources from various publications. We're getting data from analytics houses, other data houses as well, trying to pull that together really to aggregate the key articles or key resources that we want our sales teams to have engagement with our clients to talk around either a pitch or a trade idea. And you can imagine we were getting tens and thousands of structured, unstructured documents a day. They were being reviewed by a team of graduates, which was rather frustrating to not have the right skills being used. And they would spend a whole day finalizing a list of 100 documents that they would then go to sales, and then they would push that. We worked with the teams to do really basic stuff like rules-based matching to start with. Then we applied the NLP scoring, so it gave them a scoring capability. Then we applied another level, which was actually an explainability model on top of that, to actually give a top 10 recommendation list for sales to have conversations with the clients. So that reduced answers the efficiency point. There's an automation aspect, but there was also already an inbuilt explainability model to say, well, how did you reach that decision? How did you get to those top 10? And why should I be taking that recommendation or idea to a client? So I think the explainability model kind of needs to be embedded within the whole process. I don't think adding it afterwards doesn't make a lot of sense. I think it needs to be all the way through. And the explainability model was used to explain back in layman's terms or layperson's terms to the salespeople to say this is how we reached that decision, because they wanted to have the confidence about the decision that was made. And they wanted the ability to change that as well, to say, well, we think that particular research article is not that relevant for our clients. So we said, okay, well, here's a tool. You go in, change the category, and amend it. So we're finding salespeople are also involved and engaged in that process to change the model, not directly, but at least the categorization layer, and also helps them to expand the explainability model, helps them to explain it themselves as well going forward. So it depends on the use case. Explainability is in the heart of it, depending on where you get to, and getting the right people engaged in that will help with going back to your question around regulatory or regulation to explain how did we get there.
All right, thank you so much. Paul, do you want to add?
Yeah, just not much to add to what Sohail said, to be honest. I think that was completely agreeing, very comprehensive. I think my main point has already been made, that this can't be an afterthought. Like explainability, certainly from a regulatory perspective, and this is something that's going to get a lot of both regulators' attention, but as well, as soon as it really starts hitting clients, you're going to get lots of pressure. There's lots of risk, regulatory risk, but also reputational risk from these things. So the explainability needs to be one of your first thoughts, not one of your last thoughts. And it needs to really be either the design needs to be built with that in mind from the beginning, or if you're selecting a vendor product, that needs to be one of your first criteria, absolutely for key. The other thing that I just want to sort of put out there is that the model is one aspect, but also the state of your data estate at the point that the model has made that recommendation is the other thing. So if you need to be able to explain why did you make this recommendation 8 weeks ago, you also have to be able to say, well, this was the state of our data estate 8 weeks ago at the point that the model made the recommendation as well. So again, model is part of it, data is part of it as well, and you basically need to be able to pinpoint exactly the state of those things that fed into that particular recommendation.
All right, thank you so much. I think there's a lot to talk about on explainability, so let's move on to the next question, which in a way is also linked to explainability, and that's about regulation. We all hear a lot about machine learning, and honestly, it's becoming a bit of a boredom. And well, soon there will be another terminology, machine unlearning. And that's about the right to be forgotten. So if I have a data point with a bank or institutions, I have the right and demand for these data points to be forgotten. So that, as you can imagine, is heavily linked to regulation. At some point in future, a regulator might actually demand that. It might demand for the data points of the users to be forgotten. And some of the organizations that I don't want to name them have already kind of implemented that. So the question is how firms and financial institutions can prepare them for that scenario. Machine learning is a very expensive procedure. So there are ways of doing it. It's not really clear what is the best way of doing that. And it would be really good for any firm or financial institutions to be prepared for scenarios like that. So machine learning was an example here, but the general question is how firms can prepare themselves for these tightening regulatory developments around AI. I would like to start with Paul.
Yeah, and I like this. I think this is quite a nice summary of all the points that I've made so far, to be honest. So, yeah, we are used to dealing with financial regulators, and that is going to continue for this. But I think there's also going to be more, dare I say, generic regulation. I'd compare it almost more to things like GDPR that's affected every industry. There's going to be the machine learning and AI kind of thing there will be financial services specific regulation, but there'll be more generic regulation as well. So I think what confirms do, the first is engage with regulators and industry bodies. I think there are a lot of opportunities to engage. So, don't just sit back and and wait for the latest piece of regulation to come and hit you. Sort of actively go and engage. But some other proactive things I think you can do. Again, we've spoken a lot about data architecture, so you can continue to try and get your data and your data architecture sorted, so that when these questions about things like explainability comes up, then you're in a far stronger position to be able to answer some of those questions. Back to my point about knowledge within the organization, particularly at those senior levels, again, continuing to build that, so that when these things become, real things that the regulators want to speak to you about, or I talked about regulatory and reputational risk earlier, you need your senior leaders to actually be fully equipped to be able to talk about these things. So continue to build that knowledge in your organization, and then sort of finally know the current state of your data. So where your data is, how it's stored, how it's used, and then sort of final thought, which is a huge one, and we could have a whole panel discussion on this as well, is that a lot of models obviously are trained on historical data sets. Now in wealth management, if a lot of your historical data sets come from upper middle class, middle-aged and older white straight men, then just realize that therefore there are going to be biases in those data sets. So I think this is key, that whatever data set you're looking at, whatever data set you're using to train your models, think about where the biases could be and what sort of spots that leaves in your field of vision, because that could be a real challenging area for you in the future, I think.
Okay, thank you so much. Sohail, do you want to add?
No, I don't think there's a lot to add. I think Paul's covered quite a lot there. So from my perspective, I think it goes back to everyone taking responsibility for the data, understanding what the implications are with the regulators. And also we're finding there are opportunities we talked briefly about with models, but also with FinTechs that actually focus specifically on the aspects of GDPR data, data to regulators, the proving of it, the explainability. There's certainly an opportunity there, and there's been a couple of FinTechs that have approached us at SocGen to work with us closely on that, and that's going to be, I think, unfortunately, a growth area for, if anyone can grab that opportunity. I think that there's something there that could be taken forward as data provision for firms to look at. Maybe KPMG have got something there, so I'm sure Paul will award me afterwards that there is something available already. So, but no, not a lot to add other than regulatory challenges will continue and prevail.
All right, thank you so much. The next topic is about the implications and implementations of ethics and morals in AI systems. So these are very qualitative terms. It's easy to talk about them, but actually how you implement them in your system. This is also linked to the regulation, as you can imagine. And one answer would be that if we can explain a model, then we can convince a regulator, or we can convince the audience that our system is fair and unbiased. But the bad news is even explainability by itself can be manipulated, and we have actually evidence of that. So the next question, which is very qualitative and really hard to answer, is what are the ethical implications of algorithms, how they can be incorporated in the build-up of this algorithm, if at all? Paul, maybe I should start with you.
Yeah, I think referring to my previous answer, a lot of this I think is about bias. So you've really, as one of the fellow panelists said earlier, the days of being able to go, oh, I'm sorry, the model told me to do this. I mean, if they ever existed, which I doubt, they are long dead. So, you can't hide behind that. So it is about, as Sohail was saying, people taking responsibility and realizing that the responsibility still sits with the organization and the individuals in that organization. So if there are biases in those data sets, you need to have thought about that, you need to have interrogated that, and you need to work with the appropriate people to think about how you can safeguard against those, resulting in you basically making unethical decisions, really.
All right, thank you so much. So Sohail, if you agree, we can move on to the audience question. I think the first question was pretty much addressed, why is explainable AI important? So I think we talked quite sufficiently about that, but if you like to add anything, I think we pretty much covered that. Okay. The next question, which is a bit long, so basically it implies that we have been talking about very boring stuff. Okay, so I summarize the question, where can you see more radical advantage of AI or machine learning, if any?
Shall I start?
Radical.
This is, well, I think one of the, we started, and both Sohail and I listed off a load of technologies that I would call sort of emerging technologies that we both happen to be interested in. I think a lot of the radical, interesting stuff comes in combining some of these technologies together. So one of the things I spend probably too much of my time thinking about is, can you combine things like machine learning, AI, with distributed ledger technologies, blockchain, and imagine a future in, who knows, guess a time frame, 10 years time, when the dominance of the mutual fund is gone. And back to that personalization point of view, particularly for wealth clients, we're no longer relying on building a portfolio of mutual funds, but we actually have a sort of highly bespoke, curated portfolio of investments specific to each individual client's risk profile, investment horizons, ESG profile, et cetera, et cetera. I think that's something that I find very interesting.
Yeah, I think the technology, is it a technology question? I think the models themselves are, well, if you're a data scientist, are very well known. There hasn't really changed in the last, and you can obviously, from an academic point of view, Ramin, either confirm that or tell me I'm completely wrong. But the models themselves haven't changed. It's the use and applicability where obviously the technology has allowed us to do that. But I think where we're going to see the radical change, if we're going to call it radical, is more the product innovation and the services that we offer to clients. I think there's immense opportunity, particularly from a structured products background. If I look at my background, the rate of innovation within structured products, if you look at indices, for example, they've been based on machine learning algorithms now. Some of those are being pushed forward as well, as followed by NASDAQ and S&P have got their own stack called alpha indices. Check them out and you can see the algorithms that are behind that to create those indices. And I think that's really fascinating. I think the product innovation in terms of product sets, products that we might be offering to wealth clients or from an IB to a wealth client is going to be interesting as well. So for me, it's about product innovation. I think the opportunity is more around that.
Okay, thank you so much. The next question is actually a very interesting one. So let's say that we have access to future. We have access to a very well-developed AI system that can answer all your questions, like return modeling, risk management, whatever. What would be the first question that you would actually ask? Maybe Paul?
Other than the winning lottery numbers for the Euro Millions on Friday, I guess, I mean, I joke, but something like that, what is for, if let's say, my pension horizon of, well, probably now say 20 years or something. So for 20 years, what is the best way for me personally to maximize my assets that I can have the most comfortable retirement possible? I think those are the sorts of questions that we need. The question hasn't really changed dramatically, to be honest, but maybe the ability for technology to give us more interesting insights into the answers around those questions might change, I think.
Yes, as we're in a wealth conference, I'd probably say, when can I retire? That would be my question, and can I retire as well?
All right, thank you very much. So yeah, that's all for our session. Unfortunately, there is a lot more to talk about, but our time is limited. I will thank you, everyone, especially I thank our speakers for your time and attention. Thank you so much and have a nice day.